In this week's video, we'll review the hard evidence and try to answer the question, can stock bulls survive slowing momentum and indecisiveness? As we review the charts, we'll see a lot of flat and horizontal lines which speak to slowing momentum. Flat means indecisive, and indecisiveness calls for maximum flexibility. Discipline is the key to success here. Before we revisit the topic of discipline, let's look at what we'll be covering in this week's video quickly. We still have a tentative market, so the big picture is relevant. We'll look at the CCM market model and the current readings, touch on Dow theory, check in on emerging markets, the fear index, credit markets, risk on versus risk off, the long-term breakout chart that we've been following, and talk a little bit about the broad market versus the S&P 500 index. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Since a picture is worth 1,000 words, let's look at a real-life example where staying with the math, the hard data, our discipline, and rules paid off. This is an indecisive period in the S&P 500. This is 1994. You can imagine if you were running the market model in this period, frustration would be part of the equation. The key to coming out on the right side of this market is staying disciplined and following the rules and remaining patient. This is the frustration period, consolidation, indecisiveness. This is why following the rules and remaining disciplined is important. After a period of frustration and consolidation, typically markets break out and you have a big move in either direction. The longer the period of frustration and consolidation, the higher the probability that you will get a big move. If you stay disciplined within this box, the math will get you on the right side of the market when resolution finally comes. And that's if it's a bullish resolution, as it was in 1995. The reward here for this period of frustration was a 37% gain in the S&P 500. The math will get you on the right side of the market, even if it's a bearish move. The longer we move sideways and the longer we're frustrated, the higher the probability that a big move is coming. This is a partial screenshot of the master CCM market model. While it's an oversimplification for illustrative purposes, you can think in these terms. The market model asks and answers thousands of binary and unbiased questions about the financial markets from a risk-on and risk-off perspective. As of the close on Friday, April 4th, roughly 67% of those answers are coming back bullish. About a third of them are coming back bearish. However, when we have flat slopes and slowing momentum, you can see or visualize that it's very, very easy for this 67 to drop below 50, and that speaks to vulnerability. Still bullish, but still vulnerable. These are a handful of the risk-on, risk-off ratios tracked by the CCM market model. And you'll see a common theme here. This is the credit markets, junk or high-yield bonds relative to more conservative treasuries. JNK is I'm chasing yield, and I'm confident I will get paid back. TLT is risk-off. I'm more concerned about return of principal than yield. You can see this is the beginning of the year. For the most part, we have had a horizontal look with no clear winner. S&P 500 relative to the VIX Fear Index. Risk on divided by risk off. Once again, indecisiveness, flat moving averages. Another risk on, risk off chart. S&P 500 relative to TLT or long-term treasuries. Horizontal, indecisive look calling for patience and calling for sticking to our discipline. This is the S&P 500 weekly. You can see this was 1848 in December of last year. We closed Friday on April 4th at roughly the same level. We're not even 20 points above that. Again, speaking to a horizontal, indecisive look, but a look that still favors bullish outcomes. Resistance, resistance, support. We're still above that, and we still have a full-bore yet tentative bullish look on the weekly chart of the S&P 500 with price above both moving averages, blue above red, and the slopes up. As long as we maintain this look, we're in decent shape on the stock side. If it morphs into something more like this and moves into this area here, our concerns will increase. Similar setup here. Stocks relative to bonds. I'm confident versus I'm not so confident about future economic outcomes. Horizontal look, maintaining, this was resistance, support, support, so we're maintaining the breakout above support. We have not made a new high in several weeks. We have not made a new high in several weeks, which speaks to slowing momentum and a tentative outlook from investors. But again, still with a bullish look. The broader NYSE composite looks better than the S&P 500. It did make a new closing high this week. If you're a CCM client, this is one of the reasons why we cut back on the triple Qs and moved into RSP, which is a broad, equally weighted S&P 500 index, rather than SPY. The next chart we'll look at is emerging markets. It'll be providing an update to the analysis from April 3rd. If you Google this title here, you can find that analysis either on Seeking Alpha or on our blog, Short Takes. The EEM SPX ratio, or emerging markets divided by the S&P 500 chart covered in that article, closed Friday on April 4th at the resistance level. The article tells us why this is important for stocks in general and why it's important for holders of EEM. Circling back to the U.S. stock market, the next two charts also align with somewhat of the mixed bag story. The NYSE Composite weekly breakout that we've been tracking, the NYSE Composite, despite Friday's sell-off, still gained almost 0.8% this week, and it remains above this breakout level. So if you just looked at this chart in isolation and you didn't know what happened on Friday, you would have to say that this chart still leans towards the bullish end of the spectrum. However, our weekly momentum and indecisiveness is showing up here. It's hard to see, but weekly momentum did close below, just slightly below, -20 here, meaning we have dropped out of overbought territory on a weekly closing basis. As we know, when that happens, the probability of bad things happening in the stock market increases. So we still have that slowing momentum to be concerned about heading into next week. The cash buffer that we currently have using the CCM market model is offsetting this weak momentum. Why have we cut back on our exposure to technology stocks? Well, here's one of the reasons. The momentum on this chart is even worse from a weekly perspective. You can see we didn't overtake -20 here. Typically that's a bad sign. And now we're below -50. This needs to be watched, and is another reason why we have a higher cash position and why we're a little bit concerned and watching things a little bit more closely from a risk management perspective. You can find Friday's research post by Googling this article title. The basic concepts outlined in the article and the charts align with the other charts and the CCM market model that we're covering in this week's video. It just gives us one more thing to look for and track next week. Transitioning back to the glass half full perspective, This is the weekly chart of the S&P 500 index. These are our moving averages. This is a full bore bullish look here, full bore bearish look here. You can see we have a mixed bag, but we still, by definition, have a full bore bullish look. This look here needs to morph into something more like this or this, where weakness in the stock market followed, for our concerns to increase from a weekly trend perspective. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.